Live from Data Studio in Paris, I'm your host, Raphael. Welcome to a new episode of Data eCommerce podcast. Guys, I don't know if you heard about investors pouring billions towards building e-commerce brand houses. It's all over the news if you follow even a little bit what's happening in the Amazon world. These guys are building the P&Gs of tomorrow. And if you want to know more about it, understand what's an e-commerce brand house, why is there a market explosion right now? I mean, we're talking about hundreds of brands that have already been bought out. And why you should care about it, stay tuned. Pat, Amazon expert at DataOak, is with us today. Pat, how's it going?
Excellent, Rafa. Thank you for having me. I've got tons of great stuff to share with you today.
Awesome. Let's get into it. Let me start by asking the most obvious question. What are e-commerce brand houses?
I like how you refer to them as e-commerce brand houses, Rafa, because it makes them sound very elite. So e-commerce brand houses or FBA roll-ups are essentially businesses which acquire and then scale small brands which are using FBA to sell on Amazon and have demonstrated success in doing so.
Okay, wait. Why the focus on FBA sellers?
Well, generally speaking, it's no secret that success on Amazon and using FBA, they go hand in hand, right? Most successful sellers on Amazon use FBA. So while there may be brands which don't use FBA and are still successful and may still be of interest to e-commerce brand houses, they'd make up a very small portion of the target market. The vast majority of brands purchased by e-commerce brand houses used FBA when they were purchased.
Okay, so my question is why today? Why are we talking about this today? What changed?
Well, because the space is really heating up, right? Every single day I hear of some e-commerce brand house having raised tens of millions of dollars, if not hundreds of millions. In February alone, I read about Thrasio.
Yeah, the largest acquirer of Amazon businesses and one of the top 25 sellers. I did my homework.
Your knowledge of e-commerce is better than I had thought it was.
Just to give some background.
Yeah, they raised 750 million, and Branded raised 150 million. Elevate Brands raised 55 million.
Wow. So. I mean, how come? I mean, I'm very curious to know. It's amazing. How come the sudden emergence, or rather explosion, of this trend and business model?
Yes, that's an interesting question, Rafa. And there are so many reasons, right? There are essentially three sides to this. You've got the investor side, which is pumping the money in. You've got the e-commerce brand house side, which came up with the model, and the brand side, wherein brands want to exit their company.
Okay. So let's start with the investor side, please.
Sure. So brass tacks, Rafa, money flows where the opportunity is, right? So in 2020, 3P sellers accounted for 300 billion in sales on Amazon. That number is set to double in the next 5 years, meaning we're looking at a $600 billion industry.
Wow.
Essentially, the whole pie is just getting massive. so it's no surprise that this opportunity has got the attention of investors.
Of course.
Right? Secondly, interest rates are at an all-time low. You'd be stupid to not borrow, really. And after you borrow, what do? You invest, right?
Yeah.
So there's all this cheap money available and equities are high. So investors are looking for new asset classes, right? They're looking for other channels to invest in. Hence the massive fundraisers.
That makes sense.
And if we were to take a step back, the first phase was the lending phase, which started a few years ago. Investors saw an opportunity and began lending to these micro brands. Then they decided to take it up a notch, and here we are. So billions of dollars have been raised, and hundreds, if not thousands, of brands have been bought out, like you said.
Super interesting. And what about the e-commerce brand houses side? What do we got?
Yeah, it was just a matter of time, right? I mean, how many anchors have we seen come out of Amazon?
Yeah.
Anchor recently IPO'd at 10 billion, right? Yeah, but that's just one example. I can't think of others. For years, these micro brands which were operating on Amazon just weren't sophisticated enough. They simply lacked the necessary tools and expertise to scale, right? The founders of these brands, they had expertise in product development but not retail.
Yeah.
They created great products, but that's it. And I can tell you this from experience because when I was working at Stores 1 to 3, we were working with all these brands which had great products, but would send inventory updates to us via Excel data feeds once a day. And that same data feed would go to multiple resellers. They'd all list the same number of units on Amazon and then face out of stock issues because one of the other resellers had already made some sales and placed orders with the brand, but the brand wasn't updating the inventory feed in real time.
Okay.
Right? Or say the brands didn't have SEO or Amazon advertising expertise, right? Meaning they wouldn't show up top of search. Or also in terms of images, videos, and A+ content, the brands simply didn't have expertise in those areas. So the e-commerce brand houses sensed an opportunity there, right? They were like, okay, these products are great, they sell well, but we can really scale them. Introduce variants of the product, improve their organic visibility, invest in advertising, make them available on other channels like Walmart, take them international like UK or Europe. Basically marry their money and tech and services expertise with the incredible product and then scale it.
Super clear. And what about the on the brand side? Sorry.
Right. So 1 million 3P sellers joined Amazon in 2020 alone. Right. Their total count today is close to 5 million. And why this explosion? Well, because barriers to entry have come way down, Rafa. It's easy to source,
right.
Thanks to companies like Alibaba. Yeah. It's easy to launch thanks to YouTube. Where there are tons of tutorial videos. You don't need to hire a consultant, and it's easy to sell, right? Just send a few units to FBA. They will store the product and ship it to the end customer. And an important point to note, Rafa, is that brands were just tired of their resellers, fighting for the buy box and engaging in price wars. It was bad for the brand's reputation and image. Mm-hmm. But for a whole array of reasons, earlier brands were just dependent on resellers.
What do you mean? It's their brand and their product. Like, why were they dependent on a reseller?
Well, for so many reasons, Rafa. And you know what? E-commerce brand houses, too, are successful for exactly those reasons. In a manner of speaking, they're contemporary resellers. So, after Amazon introduced the Inventory Performance Index, the IPI, along with it came the long-term storage bill. Meaning, if you weren't selling your inventory fast enough, you'd be presented with a large storage bill from Amazon. Resellers helped you avoid this. Why? Because large resellers were working with hundreds of brands. In any given month, due to seasonality or product type, some products would sell and others wouldn't. Though overall, Amazon's Inventory Performance Index would be satisfied, thanks to the reseller, and you'd escape having to incur long-term storage charges. Then there's shipping costs, right? As a small brand selling just their products.
Yeah, you wouldn't get much of a discount.
Exactly.
From carriers like UPS and FedEx, of course.
Exactly. However, a reseller selling products from multiple brands would have a significantly large shipping volume, thus receiving huge discounts from the carriers. I mean, even as high as 40 to 50%, right? And that too became a competitive advantage because the discounts could be passed on to shoppers, making your products look more lucrative, right? Thirdly, retail and Amazon expertise. Like I mentioned earlier, the forte of these brand owners was product development, not retail, right? Given there's hundreds of alternatives for every product on Amazon, you really need to understand SEO, Amazon advertising, right? Creatives, competition tracking, and so on. And to be visible top of search. The brand simply lacked that knowledge. And lastly, overhead costs, which got distributed when you worked with a reseller. For example, if you were a brand, let's say doing $1 million annually in sales, your product cost was about 30%, right? Referral fee, which is the Amazon referral fee, that was about 15%. Shipping cost, inclusive of both, inbound and outbound, was about 15%. Warehousing cost of 10%, covering rent, packing supplies, maybe one person for picking and packing orders, advertising costs of 15%. So that leaves you with
15.
That leaves you with 15%, right? That's $150,000. Assuming you want to set aside at least $100,000 for yourself, you're left with $50,000 to spend on human resource. You can't hire a data analyst plus an advertising personnel plus an SEO personnel plus an accounting personnel Inventory. Exactly. Someone to manage your inventory, all for $50,000 a year. This is not India.
Not even India. Yeah, I was going to say it's terrible.
But if you work with a reseller, because they're working with multiple brands, they hire the people who do the same work, except for multiple brands, and then the cost gets distributed over multiple accounts.
Right. Economy of scales. Yeah. Business 101.
Exactly. Yes. So when you think about it, that's also the value proposition of e-commerce brand houses, right? So yes, these were some of the reasons why micro brands were dependent on resellers and the opportunity e-commerce brand houses are seeking to tap. Anyhow, we think this trend is only set to accelerate as micro brands are seeing a lot of success on Amazon and are starting to grab market share from larger brands, which have been around for a much longer time. Yeah. And we see this all the time, when we prepare our Amazon category bestsellers or, the Amazon share of voice reports and
Absolutely. Yeah, it's completely true. But hey, let's promote Dataok a little later in the episode, okay?
Okay.
So we cover all of this. So now, who are the dominant players in the space today, Pat?
Yeah, there's quite a few actually. As the opportunity is large enough to warrant multiple players, participants. You've got Thrasio, like you mentioned earlier,
yeah.
right, which has already raised over $1 billion in funding and has acquired over 100 brands already. So I don't know if you know this, Rafa. They're currently acquiring 1.5 million in revenue per day.
Wow.
Why? Because they're acquiring 2 to 3 brands a week.
Wow.
Right, and then you've got Boosted Commerce, which raised upwards of 80 million late last year. And then you've got one of the most recent entrants, Branded, which just came out of stealth mode and has already hit a sales run rate of 150 million as a result of acquisitions. Right, Elevate Brands just announced a 55 million fundraise just last week, and then of course you've got Perch, which in December of 2020 announced that they had already acquired 20 brands and raised north of 100 million.
Damn, that is very exciting time in the space, huh?
Yeah, for sure.
What do these e-commerce brand houses look for in brands? As in, what decide whether or not they should acquire a particular brand, Pat?
I'm glad you asked, Rafa. I mean, I can feel some excitement on your side. Are you planning on launching your own brand?
Yeah, I mean, everything is in slow motion for over a year now, for everyone actually. So I have more time for my own project, right? For my side project. I thought this could be the perfect time to do it. Well, let's bring Dataok to the moon first, and then we'll see.
All right. Okay, so first and foremost, they want to acquire DTC sellers.
Right.
Sellers who have a brand that they own. That is, the seller must own the trademark. They're not looking at acquiring resellers, meaning they're not looking at acquiring a Pharmapack, so one of the biggest resellers in the world, if not the biggest. The brand must be on Amazon's brand registry, right? They want to buy a business, not a product. That is, that if the vast majority of a brand's business is generated by a single product, the multiple they will receive will be lower. The reason for that is risk, right? Because what if the SKU gets suppressed by Amazon or falls out of favor with shoppers?
Yeah, they should also have like product who's high organic visibility, I guess.
Yeah, exactly. The product should have high organic visibility, be top of search results and a low TAR cost, right? The product should not be a fad, like, a fashionable today, gone tomorrow kind of a product, right? There should be a low risk of obsolescence because if your brand, let's say, makes iPhone cases and Apple rolls out a new model every year, they're probably not going to be interested in your brand,
of course,
right? And just the way you're not interested in your old iPhone anymore, somebody's not going to be interested in buying your brand anymore,
That makes sense.
So your brand should have great ratings and reviews because that's the ultimate vote of confidence in your products, right? It shows that shoppers truly like your products or maybe dislike your products, right? And you should have low return rates again, because that's another really important metric, proving shoppers like your products. You should have profitable unit economics, that is, make money on every single sale. And in my opinion, Rafa, the best niches are CPG products with high LTV, right? Because these are products which lead to repeat purchases.
Okay, yeah, that makes sense. So basically, you need to be successful on Amazon to be bought.
Pretty much, exactly.
Looks like you read on your own book, man.
Well,
it's really interesting.
Well, Rafa, bars are shut, so I have a lot of time.
I feel you. What are these e-commerce brand houses looking to achieve? Like, really? Like, are they just looking at brands as investment vehicles, which they will build and then sell at a higher valuation? Like, what's the plan here? Or are we at the cusp of something bigger? Like,
yeah, well, Rafa, the truth is these guys are looking to build the P&Gs, RBs, Unilevers of tomorrow.
Okay.
They're looking to build, household brands. They will go multi-channel. They will go omni-channel. They will be available on shelves in supermarkets.
Okay.
Yeah, exactly. And they will build out their own warehouses. They're looking at achieving scale, and that scale will have tremendous impact throughout the business. You name it. I mean, sourcing, because they will carry a much larger catalog. Naturally, their sourcing volumes will be higher, entitling them to better prices, right? On the logistics front, they will consolidate containers and incur, reduced inbound costs, right? On the sales front, they will introduce, let's say, child ASINs, which will help expand the various modes, reviews, ratings, star rating, organic visibility, and so on, right? And think of advertising. I mean, they'll have enough of their own products to run product ads on, on their own PDPs, meaning you will not see a competing product on their PDPs, They will expand to other channels, Walmart being one of the first. In fact, both Perch and Thrasio, they're both already on Walmart, And they will expand to new geographies, meaning they will essentially scale the brands to their true potential.
I mean, you mentioned P&G, right? That's interesting because today P&G have really, really deep pockets.
Yeah.
Why can't they do exactly what Thrasio is doing? Meaning, why can't they just go out and acquire brands also?
Yeah. Touchy subject.
Oh yeah, why so? I mean,
well, because
it's logical, right?
It's logical, but it's touchy for me to answer that because I don't want to offend the good folks at P&G. And I have some friends working there.
Okay, I see.
Look, Rafa, the whole business model is different, right? P&G is not a DTC company, meaning they don't sell shampoo; they sell pallets of shampoo.
Right.
You know what I mean?
Yeah.
So and traditional CPG companies, they change pricing once a year. Boosted commerce changes pricing every hour because online retail, Amazon is in their blood, right?
Yeah.
But this is a wake up call for traditional CPG companies. They need to go DTC now. Look, Target has created 6 $1 billion brands in just the last 3-4 years.
Yeah.
Traditional CPG companies, I mean, I can't think of any, right?
Yeah.
In my opinion, Rafa, they should start acquiring DTC brands and ASAP and try to scale them. In fact, Unilever started with the acquisition of Dollar Shave Club.
Right.
And one of the biggest factors behind Unilever's acquisition of Dollar Shave Club was the fact that the latter were a DTC brand with direct relationships with their customers. They just did it again with the acquisition of Smarty Pants, a DTC multivitamins company.
One of our client, yeah.
Right? And traditional CPG companies need to really accelerate their acquisitions, or in the next few years, they're going to be facing a very different competitive landscape. Look, today, Thrasio is already selling 12 to 14,000 unique products. When you factor in child essence, that's close to 50,000 products. Right? On a recent podcast, Carlos Cashman, the co-founder of Thrasio, he said that he's now thinking of how to get to selling 1 million products. And in my opinion, that day is not too far away.
Yeah, me too. I mean, basically, you answered the question by saying yes, they should acquire brands.
Exactly, for
fast.
sure.
Yeah,
Absolutely. Time's running out.
Yeah. Today, DataOak is proud to be serving companies such as Thrasio, Boosted eCommerce, Branded, leaders in the FBA acquisition space. So can you explain exactly how DataOak is helping them?
Oh, absolutely. So our analytical capabilities, allow them to quickly identify top-selling products and brands on Amazon across over 20,000 Amazon categories in all Amazon geographies, be it the US, the UK, Germany, France, Italy, and so on. And thereafter, we help them with the due diligence, So in the sense, we measure brands' organic and sponsored visibility on Amazon, right? We assess how the acquisition targets stack up against competition in terms of reviews and ratings.
Yeah.
We also provide a complete account audit of the brand's Amazon sales and advertising history, meaning that the brand's cost per click, ACOS, ROAS, TACOS, revenue net of ad spend, and so on. Essentially, it's a scorecard, Rafa, which pretty much provides a buy or don't buy recommendation for these e-commerce brand houses.
I love that last piece. Buy or don't buy. All right, that's a wrap, people. Thank you, Pat, for your time today. Really.
Well, thank you for giving me the opportunity, Rafa.
Amazing episode, throwing lights on one of the hottest trends in the Amazon world.
Yeah, for sure.
I really hope you guys enjoyed it, and we see you very, very, very soon. Bye-bye.
Bye-bye.